Well, this last question is really fun, and she watched the video very thoroughly. So she says, "Great video. I'm looking into purchasing a long-term rental property. How do you end up paying off the loan if you're doing interest-only payments? Do you just throw that extra cash to principal, or question mark?" So what she's referring to is our business model. What we do is we use private loans or private lenders, private mortgages from individuals. We borrow money at 10 and 12% interest only. We use that capital. It is a first position mortgage on the property that we're purchasing. We use that capital to purchase and rehab a home. Now, when we do this, we make sure that the property, our all in, our purchase plus rehab costs, are 75% or less of the after repair value. Now, if we're able to do that successfully, which we usually are, then once that property is renovated, once it's beautiful, once it's rented out, once there's a long like a lease in place, then we're able to take that to the bank and say, "Hey, look at this stable collateral. We would like a 20, 30-year loan on this property." They'll say, "Wow, that is very good collateral. You have done a great job. This is a income producing property. We would happily accept this as collateral on the money that we will lend you. In fact, we're going to lend you 75% of what the appraiser says that this is worth." So if we did our formula correctly and our purchase price plus rehab costs, which we borrow 100% of at 10, 12%, is truly 75% or less of the after repair value, then when the bank comes in and lends us 75% of the value that Mr. Appraiser says the home is worth, then that will be sufficient, hopefully more than sufficient, to pay off that first position mortgage that we took off with the friend or family member at 10 and 12%. It is only our intention to have an interest only loan on the property for the first 9 to 18 months of us having a property. Once we get everything situated in order and rented out, then we'll go to a traditional lender and we will refinance out that interest only loan from the beginning. And because people appreciate getting 10 to 12% on an investment where their full principal amount is secured by an asset that's ultimately worth more than the amount of money that they lent, it's an extremely stable and very predictable investment. So they don't want those monthly interest rate payments to stop. So generally, most people are motivated to do it again, which that allows us to recycle that initial capital that was used to fund that property. And we can work with that lender again to do another property. So it allows us to regularly recycle funds. And because we don't have any of our own money into the deal, because we did the formula appropriately and we found a discounted deal where we could buy it and rehab it for less than 75% of the after repair value, we're only limited by the amount of bandwidth of people that we have and or capital available from these private lenders on how quickly we can grow, because most people, regardless of how much money you have, at some point, if you're using your own capital, you're going to run out of it. But if you can prevent yourself from utilizing your own capital, then there is really no limit on how quickly you can scale, other than contractors to do the work and private lending funds available to you, and also traditional banks willing to refinance you on those properties. Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.